Hi, this is Michael Cohen. I'm a Dallas elder law and estate planning attorney. I'm joined by my friend, cohort, Don Crawford Jr., who usually asks me questions about whatever it is that I'm talking about. Today's topic is about long-term care Medicaid. The only reason why we're talking about this now is because the numbers change on January 1st of each year on how much you could keep to and still get eligible for Medicaid,
Okay.
particularly if you're married. So the dollar amount changes each year based on the consumer price index. They announced this fall that the consumer price index increase is 2.8%.
Okay.
So the amount that can be kept has been increased by that. All right, so let's say you have a married couple and one of the couple has to go into a nursing home. Most people don't have long-term care insurance and they have inadequate resources, and the cost of care is great.
Mhm.
Average cost of care is $7,800 a month. I always talk about my grandmother who went into a nursing home at 85 and lived to almost 98. Well, 13 years, can you imagine what the math would be? It's going to be over $1 million. So, you know, it's most people don't just happen to have $1 million in their pocket for long-term care. So here, and Medicare doesn't cover long-term care, maybe just a limited amount if you have a hospitalization stay. So they say, well, gee, how do we get eligible for Medicaid? Well, there are certain things that do not count, but as far as cash assets, now I say cash assets, sometimes cash assets don't count. So, for example, an IRA, a traditional IRA with a required minimum distribution, would not count as an asset. They would look at the income, but they wouldn't count as an asset. So we would look at the cash assets, whether it be the cash surrender value of a life insurance policy. You would look at savings accounts, money market, investment accounts, or if you have excess resources, other things, let's say you had a boat, or if you had a second car, one car doesn't count as a resource, or other pieces of real estate other than a homestead, then those assets would be looked at, and the government says, are you below a certain limit? Well, the limit, the quote unquote maximum protected resource amount is going up. It's going to go up to $162,660, exclusive of that home or car or pre-need funeral or burial spaces or everyday living items and some of the other exempt resources. So, but that limit of 162.60, which last year was 100 in 2025 is 157,920. Uh, if you, it could be expanded. It could be expanded. What does that mean in English? Well, there's a thing where they look at the income of the couple. The lower your income, the more you could keep without having to quote unquote spin down to get to the limit.
Okay.
Let me give you probably a few examples. And the income limit, where they would look at of the husband wife of what's called non-countable resource income is going up to $4,066.50. Now, there's other ways to get eligibility, which are going to be beyond this podcast. But let's say that the husband had income of 2,000 and let's say Social Security, and the wife had income of $1,000. That's 3,000 total. Well, if the income limit between uh, the two of the couple was $4,066.50, which is what it is for 2026, then if that limit is now that you're 1,066 below the limit, how much money do we need at today's interest rates? There's a formula to keep more than whatever the resource limit to get up to the resources that you have. So if you're 1,000 short and you had $300,000 of countable resources, well, you might be able to keep it all and still have the government pay for care because your income was low enough and they wanted to have some protection for the spouse. It used to be that people got divorced to get eligible for Medicaid because the average cost of care is so expensive. So now the income, so normally they look at your resources and they divide it by two. So if you had 300,000, they say, oh, you have to get down to 150,000. But in our example, if it was 2,000, 1,000 for one of the two spouses, you'd be able to keep, instead of only keeping 150, you keep 300.
Okay.
On the other hand, even if you had 100, that means you have to get down to 50. Now, there's a lower limit too. The lower limit's going to go up to 32,000 and change. I think it's 532, $32,532. So if you were at 50,000, one half of 50 is 25, but you could keep at least $32,532. So now let's say you were at 100,000 of countable resources between the couple, but your income between the couple, and I'm not talking about dividend or investment income. I'm talking about what they call non-countable resource income, typically your Social Security or pension or IRA required minimum distributions. Let's say you had that 300,000 and you had to get down to 150,000 because your income between the couple, instead of being 3,000, let's say it was 4,500. If it's 4,500, well, it's above that $4,066 threshold. And quite frankly, the lower your income, the more you could protect. So let's say you had 300,000 and your income was 4,500 between the couple, then you'd have to get down to 150, not that maximum of 166,000 limit. 100. So in any event, the bottom line is the 162,660 limit. The bottom line is that you have to look at the both income and assets to see which counts. And then typically what you do is you change the nature of the assets from those that count to those that do not count. There is a way to get eligibility even if if the couple was too great and you couldn't expand, and that is to sometimes, let's say that the well spouse had income alone of $4,000. Um, well, there wouldn't be any diversion, that's for sure. But there could be, what that means is, remember on the case where we said 3,000, I mean, one was 2,000, one was 1,000. Not only would you be able to keep all the assets, but the well spouse would be able to keep all the income, and the government would pay for the entire cost of care plus medications.
Mm.
Well, let's say that the well spouse alone had income of $4,500 and he had 300,000. How do I get down besides buying things like paying down a mortgage or making repairs to a home or buying a pre-need funeral? Sometimes you buy a certain type of annuity called a Medicaid compliant annuity. So you can change the assets into an income stream, but this annuity is not just any annuity. It has to fit within the rules, which is, if you're really bored, a single premium immediate annuity for a term certain, less than the life expectancy of the annuity, payable level installments of principal and interest with the state of Texas is a beneficiary, except that Medicaid benefits have been advanced after the spouse, and it has to be non-transferable and non-assignable. And I know you have that. I know
Yes.
Don has it by memory. I do,
I
I
was going to ask you to repeat that, and you probably can, which is really,
I've said it a few times.
I
So I
bet.
think, yeah. So basically, there are ways to shift the burden because most people don't, especially if you live for a long period of time. But even if you didn't, if somebody has a medical necessity, be in a nursing home and they're in a facility that accepts Medicaid and there's a Medicaid bed, they have to look at the assets. So a lot of times you just go within the rules. And the rules on the dollar amounts are changing January 1st, which is the reason why we're talking about this now, because of the new amounts. Now,
I
Don, I
think
know.
what you said is that in the end, in summation, that it's terribly case by case. Ronald Reagan, who was a president in the 80s, as everybody knows, he always used to say, trust but verify. So trust your intelligence, your math, all of that, but also verify by running it by Michael because he, as you just heard, really knows this stuff well.
Yeah, a lot of times at the workshops we do, um, people ask questions about Medicaid. We have a workshop every month,
Mhm.
and we ask at the very beginning, what would you like to know?
Right,
And typically, there could be any questions from, oh, how do I protect my home, to things like this, and you know, you just never know what the questions are going to be.
right.
If you're interested in going to the next free estate planning and Medicaid workshop, then all you have to do is call 214-720-0102. That's 214-720-0102, or sign up online at dallaselderlawyer.com. That's dallaselderlawyer.com. If you go to the free workshop, which is a 2-hour workshop, then we give you a free vision meeting. Otherwise, people just if you just want to come in and meet with me without the workshop, then you'd actually have to pay for our time. But otherwise, so these are free. It's no obligation. It's just an opportunity for you to learn something, and you learn something not only your questions, but you'll learn from the questions of others.
And they're Saturday mornings. They're typically in person, or almost always in person. I guess sometimes you do online or virtual. I guess Michael. And then thirdly, they're free, like you said. So they're really helpful and insightful for so many people, especially because relationships change so much, and so do the laws.
Yeah, yeah. I had a client in a couple weeks ago and said, "Oh, the laws haven't changed in 120 years."
Oh,
Oh,
yeah,
well,
yeah, that's
no, it
true.
changes all the time.
Yeah,
Somebody may have even heard of the one big beautiful bill, that might have
right.
happened. Our estate tax, just think about the estate tax limit. 20 years ago it was 600,000. Now it's 15 million, or will be as of January 1st.
Kind of
So it's
changed.
another thing that's changing. Wasn't the topic today, but
Right,
sometimes people ask about on the estate side.
right.
And so you never know. Some people, it's just a matter of whatever, everybody's goals are different. So that's why they have a workshop so you can learn. Thank you, Don. And if y'all have any questions, feel free to give us a call or go to our free workshop. Thank you.